You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody. That rockin' tune means it's time for the return of one of my favorites here on the old network. We don't get to crank it out as often as we'd like here, but we're looking to increase that frequency for you guys out there in this year, 2016. You know you guys love your boot camping. And my name is indeed Mark Longo from the old Options Insider Radio Network, coming to you from our Options Insider studios here in the Options Mecca of the known world, Chicago, Illinois. You kind of got to go far and wide to find any place else that even comes close from an options perspective. You know, changing a little bit, but still, this is the place to be. And certainly, weather-wise here in the beginning of 2016, it's been not that bad. All of the off-criticized, much-lamented Chicago winters kind of pretty temperate this year. So kind of nice stuff. And of course, while we're enjoying the nice temperate weather here in the old Options Insider Studios, we produce a wide array of fine content for your listening pleasure. Of course, if you want more boot camp, if you're coming to us for the first time, first off, welcome. Secondly, we got a lot of great episodes in the old archive for you guys to check out. Great thing about boot camp is it pretty much never gets old. A call is a call, a put is a put. We add new flavors, new wrinkles, and new data like we're going to talk about today to help make the argument more compelling. But the same logic applies pretty much throughout the program. So you can go start at episode 1 and kind of work your way up to where we are now, or you can jump off. You see a topic you like. I want to talk about income. I want to talk about hedging. I want to talk about volatility. Whatever the case may be, we have episodes on all that fun stuff. The best place to find it all, the mothership, theoptionsinsider.com. While you're there, of course, make sure you click around on some articles, some news, some headlines. Maybe check out Dan's other show on our network, the old Options News Rundown. The easiest place to do that, click on that Insider Radio Network tab. Top left corner of the page, all those shows pop up right in front of you. A nice graphical array of programming at your fingertips. Of course, all the big stores, also players there as well, iTunes, TuneIn, Stitcher, etc., and so on and so forth. And of course, even via our mobile app, available in all the major app stores. And however you like to listen, the site, iTunes, what have you, or via our app, while you're listening, maybe afterwards, we love to hear from you guys. Send us a question, a comment, some feedback, social media, email, however you want to get in touch with us. We love to hear from you guys. And I am also joined on the old program by my fellow Options Bootcamp drill instructor. He's got his hat and his whistle ready to go. He is the aforementioned Mr. Dan Passarelli, also known as the host of Options News Rundown. Once in a while, he likes to slum it here on the old Bootcamp program. He also hangs his hat when he's not drill instructoring over there at Market Taker Mentoring. Mr. P, welcome back to the Options Bootcamp drill instructor proving ground, sir.
Hello, Mr. Longo. It is great to be back. And, you know, by the way, everybody, Mark was talking earlier about how the weather's not bad here in Chicago. You have to appreciate that that's relative. You know, those of you who live in California or, you know, southern Florida or something like that, it frickin' sucks here in Chicago. But relatively speaking, it's not bad. I've seen much worse, you know, Januaries and Februaries than what we're looking at here.
Yeah, just a couple of years back, we had that Chiberia, which no one, I think, will ever forget in the near future. Yeah. Walking back 35 below zero, walking back from lunch, and your beverage freezes on the way back to the office, all that sort of fun stuff. None of that this year. And yeah, certainly our frame of reference is Chicago-centric. So by Chicago standards, very temperate. If you're maybe in the equatorial belt, perhaps not so much. All right, logistics and weather aside, let's get to it. let's get to why you came. Let's dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to the basic training. Like the man said, this is the portion of the show where we review some basic options, concepts, or issues or fun items and help you guys learn how to use them in your own portfolios. And today I thought we'd kick things off with an interesting review of a topic we touched on a few times because there's some interesting new data that adds an interesting new wrinkle to this arena. We're talking about, of course, an area that is near and dear, I know, to a lot of your hearts out there, particularly when you're first discovering options and you're learning about all the cool things you can do with these products. Of course, talking about income trading and how that works. And again, this is a topic we've touched on in the past. So if you want to go check out our archives over there at theoptionsinsider.com, you can search for income. You can find a lot of episodes where we take deep dives into this in a lot more detail. Episode 53 from February of last year comes to mind. It's been about a year since we've really done a deep dive into income trading. That was more on the adjustment side of the fence. Of course, 51, we did some income with covered strangles and things. I think we might get into that a little bit again today as well. Of course, we touched on income a number of times in our early episodes as well. In course, the 38, the triple income episode, aka the wheel trade. So we touched on income many times. Like I said, just go to the website, search for income on the Bootcamp page, and you'll find it all, or of course, wherever you find the program, iTunes, etc. We thought we'd review it and get into this study a little bit. Let's talk about some of the basics of income trading. Of course, when we're talking about income trading, we're talking about selling options. That is where the income portion comes in. And that's one of the things that is always so mystifying and so interesting to a lot of new options traders who, particularly, they come from the stock world and they're used to buying high dividend yield stocks. They want to create themselves a nice dividend income stream. And then they realize, wait a minute, I can use options to create a dividend income stream on any name that I want. So I don't need to go find some crazy dividend paying name and just be stuck with that name. I can trade and create an income on whatever name I choose to trade. And that's always an empowering and an attractive thing for a lot of new options traders. A lot of different ways you can do that. The most common way a lot of people like to use, of course, is the old covered call. Again, touched on that many times on our show. Basic buying of a long equity position and writing typically an out of the money call, 2 to 5% in that range. Sometimes in the money, depending on the name, if you want to get a little bit more bang for your buck, or sometimes more out of the money if you want to go more appreciation. But usually somewhere in that 2 to 5% out of the money range, giving yourself a little bit of room on the upside for the stock to run and also to collect that income. And then, of course, you can do that again, time and time again, to really structure an interesting frequency for you and structure an interesting dividend income stream. And then, of course, there's a lot of different ways you can carve that up. Well, speaking of that, before we get into some of that specifics and nuances, Dan, when someone comes to you, I'm sure you've had a lot of students come to you over the years over there at Market Taker Mentoring and say to you, hey, Mr. P, I want to get myself some of that there income. How do you usually like to go about it? Let's say someone comes to you and says, I have name X and I want to do covered call strategy on them. Do you have a typical setup you like to do? Is there a typical frequency, a typical out of the money? How do you usually like to structure these types of trades?
Yeah, I approach it from the standpoint of sort of, putting everything in your favor as possible. I'll tell you some of the ways that I see people do it. They say, if you're doing a credit spread or covered call or whatever, you should sell a whatever delta call. And that's always arbitrary. Like, there has never been a study done that says that this is the best delta call there is, because obviously options are priced relative to how far away they are from the strike price and based on time, which also affects the delta. So a bigger delta just gives you a closer to the money option and gives you greater reward and lower risk, lower money at risk. And farther away from the money options with smaller deltas give you higher probability, but less reward and greater risk if it really blows up in your face. So, like, when people say, I heard using a 25 delta is the best thing, like, it's not. Like, that doesn't make any logical sense if you understand how options are priced. So what I do is I do two things, and it's really very simple. In fact, it seems even more basic than doing something like using delta. And mind you, everyone, for those of you who are new to the show, I'm kind of a Greek sort of guy. I mean, if I find a use for the Greeks, I love, proclaiming it to the world. This is just not one of them. What I like to do for credit spreads or covered calls for that matter is look for support or resistance lines. If I'm looking at a put credit spread, I'll look for a support line and I'll sell the short put strike at or below support. For a call spread or a covered call, I look for a resistance line. I'll sell the short strike at or above resistance. Why? Because that's something real. That's where there's a track record of where the buy orders were in the past. If the stock gets to a support line, hits it, and then bounces back up, why does it bounce back up? Because it's some magic line on your computer screen? No, it's because that's where the big institutions' valuation models tell them they should buy it. So, that's something that is an actual real thing that you can use, not some arbitrary delta, not, this crazy Fibonacci or some other, magic BS. So that's one of the things from a directional standpoint. The other thing is using implied volatility. In general, most academics and a lot of traders will tell you that options are statistically overpriced in general in the long run, which is true. But they're not always universally every single time overpriced. So that means that you need to look and see if options are in this specific case overpriced. And if they are, then it sets up for a nice credit spread or a nice covered call or something.
I like that. The magic BS of Fibonacci, sir.
Yeah, you can quote me on that one.
I couldn't agree with you more. We get that, not to get sidetracked into the land of technical analysis. I guess we will for a little bit. People always write in what technical indicators do you like with options and things like that. And it seems like I put myself in that category. Sounds like you are as well. And a lot of people who are on our network who have been involved in professional trading in some capacity in their lives, particularly floor-based, have all had a lot of that just beaten out of them over the years. And I know I try to work a lot of systems. A lot of guys try to work a lot of systems, particularly for their gamma hedges and their gamma scalps when you're hedging your position. And not a lot of them really seem to accrete to anything substantive at the end of the day. So yeah, a lot of us take a dim view. Not to say that it's terrible, but at least low-hanging fruit stuff like Fibonacci. Of course, there's an argument to be made that the more low-hanging fruit the indicator is, the more people who follow it, the more useful it actually is, which is kind of a weird backward way of thought. But maybe we'll get to that on another episode. The technicals and options, or perhaps lack thereof. I'm sure some people's blood's already boiling when they hear that, who are diehard technicians. Write in if you have a question about technicals and options, or perhaps you have a suggestion for how you like to use them, and we'll maybe discuss it on a future episode. But for now, we're going to keep on rolling with the income roll, pun intended, because Dan, the interesting thing about income trading, and we talked about this on the show before too, is that there's one kind of inescapable fact about income, and that is when we talk about theta, getting back to your Greeks, theta becomes a much more favorable thing to harvest the closer you're getting to that expiration moment. Obviously the expiration day, your theta, your gamma getting near that exponential portion of the curve, things get hard to model, et cetera, et cetera. But when you're looking at income, you want to be in or near that exponential portion of the curve, because that's where the money is to be made, quite frankly. That's where you're getting the biggest percentage bang for your buck. Maybe the actual amounts you're getting is small, but still over time that adds up. And that's been certainly the case with the advent of the weekly options over the last couple of years. Weeklies have just become all the rage. I'm sure you have a lot of students, Dan, coming to you now saying, hey, what do I do with these weeklies? Weeklies, it seems like the entire use case for these products has shifted to the premium selling component. People just sell these things all day long because they know that they're high gamma and high decay products. They decay very rapidly. So if you're selling options, that's obviously an attractive thing. And all of this migrating into the weeklies, all of this volume has a lot of people shaking their heads about what exactly the impact is. And you can maybe intuitively think, well, these products pretty much live and die in their entirety in that near exponential portion of the theta decay curve, so they should be very attractive from an income perspective. Well, we finally have some data backing that up. This first one coming out of the SIBO. They're talking about one of their indices. SIBO has a variety of different indexes, not just the SPX that they put out there, but also indexes that they compile and aggregate and license off of products like the SPX. One of them being the BXM, which is a covered call writing index, which tracks writing an at-the-money covered call on the S&P every month and how that performs versus the S&P itself. And then, of course, the other is the the PUT, P-U-T. Which is their put right, does essentially exactly the same thing, writes a put on at-the-money put on the S&P 500. You can certainly dig into those if you're interested in those in a little bit more detail. But what's interesting about this data they just came out with is they finally added a new wrinkle to the put index, which is now the WPUT, or the weekly put. And as you might take away from that title, this tracks the writing of a weekly put versus a regular standard monthly put like they have been doing, and how that breaks down. And Dan, the findings are kind of interesting. They kind of back up what a lot of people have been assuming about the weeklies for some time. Obviously, first off, the chunk you're actually getting with each sale is going to be smaller because you're doing 4 weeklies a month versus 1 monthly. So the individual trades are smaller. But they found in net aggregate, it was a lot more attractive. Talking about annual premium income, so how much you actually collected over the course of the full year, writing the weekly versus the monthly. The annual gross premium was 24%, 24.1 actually for the regular monthly put versus nearly 39.3% for the weekly put index. Kind of putting a lot more data behind what we've been saying on this show for a long time, that if you migrate your liquidity into that near exponential portion of the theta curve, it's going to pay off for you in the long run. Also, the other pushback we hear a lot about writing puts is, the gap risk, the drawdown risk. Interestingly enough, on this one, they found over the last 10 years, going back with this data, granted, this product hasn't been around that long, but they can back test this methodology going back about a decade. They said the last 10 years, since the launch of weeklies, this W put has had a lower standard deviation, so lower overall risk than the put itself, so the weeklies being less risky. And also even lower standard deviation than the SPX itself, which is interesting. And from a practical perspective, your net risk, your actual maximum drawdown perspective, the maximum drawdown was 32% for the put index, 51% nearly for the SPX, and only 24.2% for the weekly put index. A lot of people out there who may be shaking their head saying, I don't know about writing these weekly puts. This actually can allay some of those fears. And talking about long-term returns as well, this doesn't have the weeklies. This has just the regular put in there, but 1,600% for the put index versus about 1,500% for the S&P over that time frame of mid-86 through 2015, so a longer time frame actually. So that time frame obviously includes several major sell-offs, including 1987, including 2000, and including the 08-09 meltdown there. So there were some periods of significant drawdown there, and yet still the put writing outperforms, kind of getting to what we've said before about how there's a lot of premium in those puts in there, and if you can find some way to harvest that for yourself, it may be an attractive way to go. So interesting stuff here, Dan. This kind of just backs up a lot of kind of what we've been saying in aggregate over time here on the program, that if you have the time to do it, and to, it takes a little bit more management. You're doing 4 weekly trades a month versus 1 monthly trade. So it takes a little bit more time, once a week versus once a month. But if you can handle that little bit of extra workload and the commissions, everything else that goes with it, over time, obviously it's going to vary on the product and things, but in general, over time, it should be dramatically beneficial to you to write more frequently rather than less, particularly getting into this weekly spectrum. You can maybe play this however you want. Maybe you do twice a month versus every month or something like that. Either way, it's probably going to stack up in your favor over the long term. So Dan, first off, what are your thoughts on this study? And then also maybe about the weeklies in general. Have you started counseling some of your mentees to start using these weeklies as some income generation tools? So what are your thoughts there?
Yeah, I mean, the one thing is I have not read the study. Okay, so I mean, I'll start there. So I mean, I can only comment just sort of anecdotally and generally. But the one thing, if we're talking about just selling puts, which I think we are, right? And did Mark tell me if the study pointed out, because again, I didn't read it. Are they talking about selling like the same delta puts or the same percentage out of the money puts?
Yeah, the BXM and put methodology is just at the money. So they write an at the money. In the first case, they were doing a monthly put, at the money put. They changed it to a weekly at the money put.
Yeah, okay. So, I mean, if we're using the same moneyness of the put, the one thing where I could play a little bit of devil's advocate about here is that if the drawdown is way less with the weeklies, first of all, that's awesome on the surface. And pretty interesting, too. I kind of leads me to wonder why, but I imagine if I read the study, I'd have known that. I should have done my homework, Mark, just like high school. But the only way I can kind of counter that a little bit is saying, well, if I sell a weekly, I'm collecting significantly less, and so the times when it does go against me, it can really blow up in my face where I'm trying to make 50 cents and I lose $10. Whereas conversely, with a longer dated option that has a bigger gamma and you're collecting more upfront, I might be trying to make $2 and I lose, $10. I lose half that. So, the risk reward sort of reflects that. It's kind of almost the same comments sort of that I talked about in the last segment that I was discussing.
So you're not lured in by the siren song of weekly writing. You want to stay in that monthly window.
Well, no, actually, no. I mean, I won't say that either. Option trading is complicated. Like there's never a hey, here's the right answer always. And because if it was, guys like me and you would be out of business. There'd be nothing to talk about. There'd be nothing to teach people. Here's the right answer. Okay, everyone go home. No need to take a class. No need to do anything. But there's not. As far as me, I did a lot of income generating over the past at least 6 months. And it was almost completely, selling puts and, covered calls as well. But it was using weeklies. Like weeklies, my standard line is weeklies are great when they're great, but when they're not, they're not, So always look at weeklies first because you can often structure a superior trade with weeklies. But, again, like don't get lured into that siren song, to steal your words, Mark, of saying, well, weeklies are always better. Look at this study. See, they're always better. They're not always better. They can be definitely better. There are some huge advantages. The bigger theta is awesome, but, it's one of your choices, but it's not always the best choice. I'll go as far as saying maybe it's usually the best choice, but it's not always.
You guys have to be a little bit judicious when you're talking. I hate to be, sound like, oh, well, that means everyone should go out and just blast away downside puts in the weeklies because that's been a use case a lot of people have been using them for. And we've seen certainly this month that it's been it's a dangerous road to hoe right now with plus or minus 1% moves in the major indices on an almost daily basis. So, yeah, we don't want to be seen as touting that. But there is some interesting data. And I think it's more interesting to people having their thought process a little bit opened up to the use case of weeklies. Maybe they just wanted to set it and forget it once a month, once a quarter type approach. This just gets more data into the more you migrate your liquidity a little bit closer to the fire, a little bit closer to the expiration cycle. It's going to work out for you in the long term. I know it's counterintuitive to people to think, well, I'm getting less every time. How can this possibly be better for me? You're getting less, but you're doing it more often. So therefore, in time, like they say, you make it up in volume. And you're going to make it up in volume here on the nearer term. So whether you use the weeklies or you structure some other type way, maybe go every 2 weeks or something like that, it just will behoove you over the long term to think a little bit shorter term with some of your income writing. So that's why I wanted to touch on this, a little bit of a refresher on income with some of this new data. You can find this study itself on our website. I'll encourage Dan to read it as well so he can do his homework, listeners. Or if you want to find it for yourself, the name of this study is big mouthful, an analysis of index option writing with monthly and weekly rollover. You can get into all the nuances of the study itself and comparing it to standard indices and benchmarks from a risk perspective, from an income perspective, from a drawdown perspective, from a total return perspective, et cetera, et cetera. It's pretty interesting reading if you want to really get into more of the income trading for yourself. I know a lot of you guys out there do. So check that study out. And of course, check out our archived episodes on income and all the other fun stuff we've done with that Theta here on the program. Meanwhile, since you don't get to do this show as often as we like, I want to make sure you guys get your time on the old program as well. So without further ado, let's dive right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call. This is the portion of the show where you guys get to chime in with your questions and comments. We're actually going to start things off a little bit differently, actually. We're going to start off with something we chimed out to you for you guys to chime back in on with us. A little bit confusing. Follow along with us here. We put out an interesting poll. Started doing more options polling and questions on our Twitter just to kind of see what you guys are interested in, active to. So we put out a question, our inaugural options question of the week this week. We wanted to touch on some controversial topic, and the one that's very hot for a lot of people right now. Of course, we're in the middle of earnings season. We're recording this right now, listeners. Everyone's writing to us all the time saying, how come we can't trade options after hours? So I put out that poll for you guys to weigh in on. I said, quite frankly, should options trade after hours. And I gave them 4 different choices. Heck yeah. Only in major names, so kind of a limited rollout. And then a couple of choices for no. You can only do 4 choices in a Twitter poll. I'd like to have done more, but no, because they're worried about poor liquidity, or no, maybe just other. And so right now, Dan, no cheating. Don't look at our Twitter, but we put it out to our 10,000 plus followers. And so far, it's only a day in or so, but how do you think it's breaking down so far, the responses?
I don't know. I mean, how can I not cheat? This is the day of the internet age, like
resist the urge to tweet, to cheat, sir.
Like sometimes I'm driving in my car and, some of these radio stations, they'll have like, here's the trivia question of the day. We'll take the 11th caller. And I'm thinking to myself, like, granted, I'm driving my car and I don't know. I don't answer these things anyway, but how can anybody possibly get the answer wrong? All you have to do is Google the frickin' thing, So I don't know. I digress. But I don't know, Mark. Why don't you tell us? Tell the audience. We're all dying to know.
We're all dying to know. Well, yes. Heck yes is winning with about 56% of the votes. And then second is no. No for other. And I looked at some of the reasoning people have for other. That's only 17% though, so it's a very distant no here. Let me look if I can pull up the actual comments on this one. I could tell you for a second. Some people saying options just have poor liquidity anyway, so they don't think after hours would even work. That's 12% for the poor liquidity. Other people saying they trade futures options a lot more because they go around the clock anyway, so they actually want more liquidity. But yeah, 56% for heck yes, 15% for only in major names. So it's about 70% or so saying yes in some way, shape, or form, and about 29% saying no. 12% for poor liquidity, 17% for other. I'd imagine a lot of people falling in the no category probably fall in the professional side of the space in some way, shape, or form. I know a lot of the exchanges in particular and trading firms are not fans of the after hours proposition. The brokers and the retail clients are really big fans of it, though. So that's kind of interesting. Mr. P, where do you fall on the hot options after hours debate? Yay or nay, sir?
I mean, I like the idea of having the market close at the time it closes. And part of that is because I'm just a little old-fashioned and don't like to change, I imagine. But part of it too, and part of it is, man, I think people need a break. Like, if that's all you're doing with your life is trading full-time, you need some other sort of hobby. You're going to burn yourself out. That being said, also, if you look at stocks that trade after hours, they're not as liquid after hours as they are during the day. You'll see, because there's smaller size on the bid and the offer, stocks move a lot more on nothing and then can sometimes kind of tend to just, bounce back really quickly because it's a BS move. And so that means that you'd be trading options based on something that's not quite as reliable. And then on top of that, because of that, the option liquidity, the options bid-ask spreads, would probably be super wide, and it wouldn't be a good thing for traders, especially retail traders who aren't accustomed to really being able to, get a broker in there and work the system and really get a good price like a professional, can, who's got a broker really working it and crossing the order or whatever like that. So I don't think it benefits anybody in any way really to have after hours option trading. I mean, just wait till the frickin' morning, man.
I'm going to take the counterpoint on that. Crossfire, point, counterpoint. Jane, you're ignorant slut. But I hear that argument raised a lot, and certainly whenever I broach this subject on our radio or things with the heads of the exchanges or a lot of the other firms, that's the argument that's raised most often against it, is that the notion that a lot of effort has been put into creating a good experience for the end retail customer on an options trading perspective, and that simply would not be able to be replicated in the after hours. It'd be less liquidity, it'd be fragmented, and it wouldn't be a good experience. I hear all that. I hear all that criticism, and I understand that. Yeah, on the flip side, what we see right now is just kind of, let's say earnings season. This is the time this question comes around a lot. This is when people really seems to rub people the wrong way. Let's say you're coming in, you're doing things in a way you're supposed to do. You're trading, risk mitigated fashion, or let's say you've got some premium on in earnings name A, Google, whatever. and you bought, let's just say you went crazy. Let's just say you're not even doing risk mitigation. You're just doing a straddle. You bought the straddle for, I don't know, $25. And in the after hours now, you see this massive crazy rally. The thing is up 50 handles in the after hours. You're saying to yourself, wow, I'm rich. I did it. I hit the home run. I got my money. I got my movement. I'm really doing well. So you leave, you go to bed. Woohoo, I'm happy. Can't wait to collect on the open. You're working your orders at the open to sell at this level. Sell that straddle out for $50+ or the calls at the very least. And you're a happy camper. Doubled your money. And you come in the morning, and how many times have we seen this, Dan? And the earnings crazy move in the after hours is gone. It's pretty much unched by the open. And so all of this move that did exist tangibly in the underlying for a decent period of time was completely out of your reach to access as an options trader. A stock guy, you could. So if you can argue you're a more sophisticated options trader, if you have a more sophisticated account with the margin to allow it, you could hedge that with the underlying, take a delta neutral approach. So you could have sold high, again, fragmented liquidity and all the other issues involved with that, the cost, having extra capital to use to hedge with underlying just sitting around in your account. Most people don't have that. So, but if they did have a way to liquidate or close out, and that's what really interests me is closing out existing open interest in the after hours in some capacity. Because right now it's just people are missing a lot of where the actual activity is, particularly around earnings time. And it's I can see it. It's deeply frustrating to a lot of people. And so I see the other argument they're not going to get a good fill, But yeah, I think you can work around that in a few ways. Yeah, it's going to be less liquid, but guess what? So is the stock. It still trades. Doesn't mean they don't trade it. They don't not offer you, I should say, IBM in the after hours or Microsoft because it's not the same experience as it is intraday. They understand that. After hours you're getting a little bit thinner. Stocks still trade. Options should do the same thing. At least give you some option, quote unquote, pun intended, to do that. And maybe you could do that by limiting it. That's how I put it in the poll. Maybe you limit it only to the major names, so only deep liquid names that are reporting earnings, and let's say the S&P 100, something like that. They have the after hours component. Maybe you also mitigate it further. You don't need market makers out there streaming quotes on every strike and every month. You have the simple limit order book like you do with a lot of these stocks after hours. If you want to work your calls on that proverbial straddle you had in your back pocket. So if you bought this thing for $25, if you want to work an order to get out for 50 odd bucks, sure, that's it. And then you close out you're closing out existing open interest. You're closing out trades. You're not establishing new ones. That might be a way to go. And who knows? Maybe the underlying will pop. Might have to pop a little bit past that level for you to get filled at that 50 handle. And so maybe you'll be upset about that. That's always a possibility. People are always upset about their fills. But at the end of the day, when it retreats back to unched, that guy's going to be pretty darn happy that he had a chance to get something. My argument has always been a little bit of liquidity, I think, is better than nothing. And if it works for stocks, I don't see why it shouldn't work for options. And I just see this drumbeat getting louder and louder in the space. And it seems like no matter how often I put it to the exchanges, they don't want to budge on this because of all the cost issues and everything else that go along with it. But I don't know. I'm kind of getting more on the other side of the fence, Dan, that I think people should have some outlet, at the very least, to close out existing open interest. So they don't have to wait till the next morning when a lot of times the reason people are coming to these events is to trade options on them in these big moves, and they can't participate in 80 to 90% of the move because it's after hours. I think that's a bad experience for those people, and they don't want to come back.
Well, it's kind of funny and ironic. I think that the people who are making that argument, the retail traders, are the ones who have reached a level of sophistication big enough, and they've traded enough where they, understand exactly even what we're talking about. Like brand new traders might not even know when the market hours are, right? Like, so the traders with some experience level. Now, those ironically probably are also people who are more income traders who put on short gamma trades. And, the example you gave, Mark, was a perfect one. Oh, I have a straddle. It moves. I can close it out, take my profit overnight. Well, that's freaking great if you have a straddle. But if you've got on an iron condor or something, if there's a big move, what happens if you're trading overnight in this crappy liquidity is that it blows through your strike and you're like, oh, I'm screwed. What am I going to do now? Well, my rules say I've got to close this. And you end up closing it out at the top, and then tomorrow morning it opens where it actually for real is trading, and you go, well, what the hell just happened? I just like blew up this awesome trade because I was looking at a totally illiquid thing that wasn't really a real price. It was a price I could trade, but it wasn't really a real price. And so like the people who would get screwed by that scenario are the income traders, are the people who sell options, because they would be closing stuff out because stuff blows through their short strikes overnight, and the only choice they have to do is to close it out and take their loss. That's the responsible thing to do, but 9 times out of 10 it's probably going to be the wrong thing to do. So I don't know, I don't know. I don't have the luxury of being able to make the rules, so I guess it doesn't matter.
I did hear one compelling argument against it too from one of the exchange heads. One of the few I heard that actually I thought made a lot of sense was just that if there's all this talk about payment for order flow and backs to execution rules in the intraday market. You wouldn't have those in the after hours. People could put up some shady business crossing trades and things on crazy prices that they couldn't get away with intraday, and so that might be a negative. So I see that as being a potential negative. But at the end of the day, I think again having some options, pun intended, for people to close out some liquidity at the very least in the after hours. I think we're getting to that point now where so many other products trade much longer days anyway and everything else. People have come to expect a greater degree of liquidity. It doesn't have to be a full, market makers on 24/7 streaming tight quotes kind of thing. It could even be just earnings season only. Maybe limit it to names that are reporting that week or that day, and they get to have the after hours and it moves on to the next one. There's ways you could structure it in like a limited pilot to test it out. At the very least, I think we should try it, because right now there's just nothing, and I don't think nothing is the answer. It's just the reason against it is because the alternative would be less than optimal than the intraday experience. But at the end of the day, I guess it breaks down to your view of is something better than nothing, or is a suboptimal experience just too negative for everybody, in which case we should do nothing. I'd encourage you guys, if you haven't done so already, hit us up on the Twitter handle there @options and vote with your clicks. I should say vote with your dollars, but there's no way to pay, so it's all free. So vote with your clicks instead. Let us know what you guys think. Seems like so far a resounding majority of you guys are weighing in on the side of after hours options trading. We'll see if this poll will be up on about the rest of the week, so we'll see another 5 days or so. So we'll see how it goes, even through the weekend, so you have some time to get in on it. All right, let's move on to a question. Just came right before the show, Dan, from Ashley. This is right up your alley, so I'll let you run with this one. She writes, if you can please discuss the timing of entries and exits using Greeks to optimize profit, that would be cool. Thanks. Well, Ashley, you'll get your wish. This is the kind of topic we get asked a lot. So we get different variations on this theme. I hear a lot of, hey, can I execute off of things like Vega? People, for some reason, really want to do that. They want to be able to say, hey, when my Vega gets to a certain level, or perhaps Delta, can I execute my trade rather than price? I hear that a lot. Don't see a lot of that functionality coming to the brokerage space yet. Maybe in the near future. The other side of that coin we hear a lot and talk about a lot is doing adjustments based on the Greeks, and that's kind of what she's getting to here on the old show, on the question. And listeners, really quick, if you want to take a deep dive into adjustments as well, I encourage you to hit up our episode 40. We did that. That was 2 years ago, Dan. That was February 2014. As trade adjustments. Maybe we are overdue for a revisiting on all fun things adjustment. But episode 40 is a deep dive. That said, adjusting with the Greeks, Dan, that's right in your wheelhouse. What do you have to say to our friend here, Miss Ashley?
Yeah, I mean, I could do 10 shows on this. I mean, I've literally done, hour and a half classes on this where I cover a small fraction of what there is to cover. But yeah, I mean, I'm all for that. I mean, that's, I think to some degree what Mark and I used to do all the time on the trading floor. I mean, getting in based on implied volatility. I mean, that's not technically a Greek or anything like that, but, using your delta and your theta and I mean, managing them, of course. As far as using them to set entries and exits, that's actually an extremely important skill. Just look at sort of the example of maybe buying a call, right? Maybe you're a breakout trader. There's tons of different trading styles. I'm just picking one of them. You're a breakout trader. You wait for 8-day moving average to cross above the 25-day moving average, and that's when you get into a trade. I don't know. Now, if you're using options, then options are derivatives whose price is based off the underlying. And so you're waiting for, the underlying to break above resistance or for the moving average to cross above, the other moving average. So you're waiting for something effectively to happen in the price of the underlying to do something with your options. So how do you enter an order to say, well, buy these calls if the underlying stock price is here? The real way to do that, and the way, even though a lot of brokers offer shortcuts, like they'll let you put in contingency orders that says, hey, if the stock goes to here, do this in the call. You should still understand what the call price might be so you're not putting in a market order. The only way you do that is by using delta. Hey, if it's a 40 delta, and if the stock rises by $1, that's my trigger point to enter my call option bid. Well, let's see. Right now, the call is offered at 360. Well, it's got a 40 delta. If the stock goes up by $1 and the call's got a 40 delta, that means the offer on the call is going to go up by 40 cents. So I put in a $4 bid. Things like that are the things that you should know. Even very basic level traders should try and get in the habit of thinking about all this. And, it's kind of a lot. And I just rattled off a whole bunch of numbers. But I would love for everybody listening to this show, who are regular fans who write into us and say, hey, we learned a lot. That's what I really want you to learn. Like this way to figure out well, where's the option going to be priced if the stock is here? Where's the options going to be priced 5 days from now if nothing changes? Where's the option going to be priced if implied volatility rises 10 points? Because that's the stuff that helps you enter orders and exit orders. And, that's the important stuff.
Yeah, these use case for the Greeks, and I don't shill for Dan, but I'll do it anyway. You can pick up his books, of course, including Trading Options Greeks and in all its myriad editions, including the new Mandarin version. So check it up if you are so inclined. And over in that neck of the woods there. And looking here, we got time for a few more here. This one, I think it's worth. We talked about this in one of our other programs, Dan, but I think it's worth bringing up on this show as well because it's kind of interesting to this audience. I want to make sure they have a chance to hear it as well. This question came in from one of our regular listeners. It was KDDiddy. He writes, I want to protect a stock position with puts at a strike 2% below the market, but there isn't a strike there. I thought of dividing my purchase between two different strikes to get an average of 2%, but I don't want the guys to call me stupid. Mom always said I was a genius, but it's hard to feel like one when buying something called a put stupid. What should I do instead? Regards, Mr. Smart. And Dan, this goes back to a long-standing debate we've had going on our option block program about call and put stupids and how they're kind of aptly named because they're not the most efficient use case for products. If you want to buy, why buy 2 strikes or 3 strikes when you can just buy the one you really want, and more effective use and position management and all the other things that go along with not doing a stupid versus doing a stupid, So we've hit on that. We won't get on that into this program here. If you want to check that out, listeners, check out the option block program for more there. But, the notion of here, he's trying to use it kind of not in an adjustment way, but trying to fine tune his hedging. So in this case, he's trying to again divide his purchase between 2 different strikes to get that average of that strike that he can't really get in the marketplace. I've had a chance to weigh in on this one kind of already, so I won't go on it at too length to give you some time to weigh in on it. But what are your thoughts? Before you even get into that, what are your thoughts on a stupid? I don't think I've ever really asked you that before. Are you a fan of that? Do you think the name is appropriate? And do you think this is a legit use case for them, or should he perhaps be migrating more and fixating on the one strike he really wants?
Yeah, let's see. Starting at the beginning of those questions, I would say that I'm not a fan of them, generally speaking. I think they're for indecisive people who just can't decide on what strike to do. Now, I understand what this guy's trying to do here, but he would not accomplish it by doing what he's suggesting. If you buy a stock at 49 and then it goes down to 48, okay, you just average price, then you paid 48.5 average price. But what you're doing here by using 2 different strike prices, that's not what you're doing. you're kind of thinking about options fundamentally wrong. And here's the perfect example where we do pull the Greeks back into the absolute necessity of thinking about options correctly. Forget about the strike price and everything. I mean, if you buy the one strike price versus the other strike price, is it a big, huge difference? No, there is a difference, but not a big, huge difference. You know what the main difference is? Is that really the Greeks are different. Well, no, there's two important differences. One is that the Greeks are different, which we'll address secondly, and the other is if stock does fall below the strike price, that's when you can exercise it and use it as the classic protection where you sell your asset. But if it falls below one strike and not the other, then you're only able to sell half of it, and you're selling half of it earlier than you wanted to because that strike is higher than where your average strike price would be. And so it becomes a lousy hedge if you only get hit on one, if only one strike gets assigned. So like there's an argument against what you're trying to do there. The other argument is if you look at it from a Greek standpoint, it's so much simpler and so much more pure. Well, if one has a 40 delta and the other has a 30 delta, sure, if you did both, you'd have a 35 delta, but you don't have to do both. Just like if you need to do, say, 10 of these at a 35 delta, well, then just ratio off one of those strike prices so that you have a 350 delta. Like what you should really care about is what is the delta that I'm getting on my hedge. That's much more important than the exact strike prices because you're probably not going to let your strikes get assigned or get exercised anyway. Like that's probably not your goal. You just want to make the money on the puts that you would lose on the stock. And so, I mean, I've already addressed the fact that like that's a lousy, like if you did allow assignment, then it's totally lousy and it's definitely not accomplishing what you want. So just look at it from a pure delta standpoint, be decisive, pick one of the strikes and do the number of contracts that it takes to get the delta that serves your hedging purpose. Hopefully that makes sense.
That's pretty much what I said discussing this question too, is that, a strike confusion, all the other inefficiency issues aside, at the end of the day, just look how many deltas you're getting. And that's what your hedge is. And that kind of goes back to that basic knowledge of the Greeks we were talking about before. See how many deltas you're buying for your bang for your buck and your delta per dollar. And that'll kind of give you a good net sense of what you're actually getting versus, forget the strikes and of course all the other craziness that ensues when you have split strikes and different hedges and all that other fun stuff. Yeah, definitely. If you can avoid this, by all means, just do it. And a basic refresher on the Greeks could help you do just that. All right, we got time for one more here. Let's go for, skip down here a little bit. Let's go to, LATom. He writes, can the drill squad explain covered strangles? RE versus covered calls. What's the difference? All right, well, luckily for you, Mr. LATom, or LATom, we did a whole episode on covered strangles not that long ago, episode 51, actually. So if you want to go check that out, that came out. Actually, it was over a year ago, though, so it was a little longer than I thought. November 19th of 2014. You can find that, and of course, in the iTunes feed or the website or anywhere else you want to go find it. We take a huge look, deep dive into covered strangles there. Quick 10,000-foot overview. Covered call we hit on earlier. That's pretty much just buying the underlying writing, typically an out-of-the-money call, but it could be any call, really, anywhere on the strike chain, in the money, out of the money, at the money type call against it, and having that be an income trade. And discussed at the top of the show as well about using the weeklies versus the monthlies. So that's a very popular trade. Coverage strangle, taking that a little bit on a different nuance. Of course, a strangle is just selling an out-of-the-money call and an out-of-the-money put together, essential, or buying it, whichever way you want to go. In this case, you're talking selling. And that, of course, because it actually strangles the underlying. You don't want it to go anywhere beyond those two strikes. Doing it in a covered capacity means, obviously, you already have the underlying for the stock, so the covered call is covered from the underlying perspective in case it gets called away. And from the put side, now, of course, that's where the term covered gets a little bit misleading, because you're actually, what you're doing is you don't have any underlying or anything, because you're going to buy underlying. So what you have to have put aside is just the capital too. So essentially, it's a cash secured put on the downside there as well. So you're tying up more capital with this trade, saying you're willing to buy the stock if it gets down to that level as well. So the upside is you're getting twice the income for it, which can be attractive, obviously. If your one income is nice, two is better. But on the flip side, there are some capital efficiency concerns with it, and also there are some risk concerns with it. So if you're worried about getting long effectively twice as much, or at least more, to the downside, depending on how many you write versus the underlying you have, that could be an issue for you. But there's a lot of good studies on this. We talked about it here on our advisors option program as well. If you head on over to optionseducation.org, going particularly into their advisors tab there, they have some good studies they've done on the efficacy of covered strangles. I think they call it a covered combo. But essentially it's the same thing. And that'll show you some of the data going back a decade or so in different products and indices and how that strategy actually outperforms and does fairly well, even from a risk perspective versus a simple covered call. It obviously outperforms a covered call because you're getting two incomes, so that does better from a total return. And from a risk perspective, it still is more attractive than the underlying itself. So interesting strategy. Check out episode 51 for a deep dive into it. Dan, anything to add really quick here on covered strangles, RE, or versus covered calls?
Yeah, I just say it is one of the strategies that I teach in very, very select classes. It's an investor strategy, not a trader strategy. I think it's really, really great for people who basically want to own a stock, because it's in an IRA or something like that. They want it for dividends. They don't want to sell it for a tax basis issue or something or other like that. You want to own the stock, but if it gets up to a certain point, you're willing to sell it. And if it gets down to a lower point, you'd like to buy more. Who's ever found themselves in a situation like that? Everybody listening to this show. So in those very specific, unique situations, I think covered strangles can be really, really great.
Yeah, again, check out that episode or that study over there at optionseducation.org, or we have it on our website as well, the Options Insider link. At least you can search for covered strangles. You should be able to find it all. All right, that's going to do it for the mail call for this episode. It's also going to do it for this episode of Options Bootcamp. But before we go, as always, let's check back in with the black-hatted one himself, Mr. Dan Passarelli. See what he has cooking in the land of market taker mentoring that may catch your eye or perhaps your options ear. Mr. P, what's cooking in the land of MTM?
Well, we just released some huge news just a few days ago. We finally, after lots of anticipation, announced where our 2016 MTM options training retreat is going to be. For those of you who don't know what that is, every year we do a 2-day in-person, on-location training retreat where us and a bunch of our students go out to a great location and have a 2-day really intensive training class and have a lot of fun too. And this year, it's going to be on July 22nd and 23rd in Telluride, Colorado, which is going to be great. We actually, it's kind of a coincidence. The breakout classes that we're having in that 2-day event cover a lot of the topics we talked about today. Option trading and retirement accounts, where we will talk about covered strangles, generating income using weeklies, go figure, and 7 options Greeks techniques you should be using, where we will surely be talking about setting up how to enter and exit trades using the Greeks. And we've got a whole bunch of other classes. We have a nice reception afterwards. It's going to be a dinner reception, watching the sunset over the Rockies. It's going to be fantastic. And if you want more information about that class, surf on over to markettaker.com/Telluride. So market like stock market, taker like you take something.com, markettaker.com/Telluride.
There you go, listeners. Surf on over there. Get yourself registered before the seats are filled. And who knows, maybe this year one of those seats will be taken by me when Dan ever so graciously sends me my first class, all-expensive paid package out to Telluride, including a nice, perhaps, you're going to dig up the old Concorde for me to have me fly out there and, all the kind of treatment that I'm accustomed to, Dan. I'll take that laugh as a definite yes.
Yeah.
Thank you for multiple yeses on my behalf. And listeners, I will quickly mute him before he can say yes some more, and that will bring to a close this episode. Of course, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. And of course, such great questions. Keep them coming. You know how to hit us up. TheOptionsInsider.com, on Twitter @Options, on The Options Insider on Facebook, Options Insider on StockTwits, or just questions at TheOptionsInsider.com. You don't have to wait for an episode to come out. If you have options questions, send them over. You have some good ones, we'll pick them, and we'll do them on the show. Maybe we'll do another mail call palooza sometime soon, because I know you guys have a lot of great questions out there. So look forward to hearing from you guys. Of course, it's all baked into the mobile app as well if you want to do it that way as well. On behalf of Dan and indeed myself, I want to thank all of you out there, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.